this, you're going to find a calming voice backed by data. It's not simply don't do anything. It's an explanation of what we should do and why we shouldn't be panicking. The overreaction which retail clients will have is one of the reasons why I wanted to do this webinar. At short notice, I grant you, but we will do a replay as well. So here we are. Get a pen and paper ready, get a comfortable seat, make sure you got one of these so you can take photos of some of the slides, because there's quite a lot of very important information on there. Let me know where you're from. Again, sorry for the very short notice, but I will do a replay. Hello, David, my friend. Hello, Graham, as well, as people get in and settle in. I've got quite a lot to get through with you. So first things first, not individual financial advice. Obviously not a solicitation to buy or sell any individual stock. This is where we are thematically over the past 1 year. Now, there's several points I want to make about this. Wow, what an amazing year, you could say. Well, hang on. What about Iran, Middle East, and what's going on right now? What might happen? We'll come to that in a second because we'll look at a shorter time frame. But one of the other things it tells me is if somebody said that some of those areas in software were going to be poor performers, I would have been surprised. If somebody said in healthcare and biotech, IT and data companies were going to drop 32%, I would have been surprised. So by having what has traditionally been called a diversified portfolio, by having a range of securities, it was the only way to mitigate against gambling on too few. Okay, so that's the first thing. Nobody ever goes all in unless they're incredibly brave on, let's say, alternative proteins. That's the first point. Second point is when the tide is rising as a whole, as it has done here, then you must be careful not to attribute success to yourself, but it's that the market had a tailwind, and that's why we did well. So your biggest danger becomes trading through panic and boredom. Now, you can write that down. In fact, you should. It's not just me who says that, but it's Warren Buffett who said that as well. Not in those exact words, because they're my words, and he doesn't tend to copy my words, unfortunately for me and him. Over trading through panic and boredom are what are going to cause people to miss things. Now, given how much green there is here, and I suspect over the next 1 to 2 years, we'll get a similar pattern. If we're lucky, it'll be exactly like this over 12 months. Maybe some of the boxes will be different. So in other words, maybe design tools will be up 70%, but foundries will be up 37%. Or over 2 years. So if we're unlucky, it'll take 2 years. The point is, there's a lot of good stuff to aim at. And it'd be pretty difficult to mess it up unless we were highly concentrated. So don't panic, don't get bored, don't overtrade, don't be highly concentrated. Okay? Don't try and foresee the future. Because if you think about it right now, the only way for you to foresee the future would be to be inside Donald Trump's head. Ain't going to happen, or his war room. In fact, I'm not even sure he knows. And it's a good example of making that point, that when people say, Alpesh, with all your expertise, and I'm going to show you research out of Goldman Sachs, JP Morgan, and Morgan Stanley in this webinar, surely you know what's going to happen. No, of course we don't. Which is why we, like Bill Gates and Warren Buffett, diversify our risk by having more than one thing. So which are the things which are in our portfolio? How are things looking? How are things going? Well, so far, up to the 1st of March, these are a selection of the client portfolios and some of the models we've created. Now, some clients have done better. Some clients might be flat, depending on what they bought, what they did. This is just a selection of some of them to give us an overview of everything from flat, in this case, because they all have different holdings based on their risk appetite, to this, the ETFs, which were selected based on which ones compared to the S&P 500 had the lowest volatility high Sortino, and have consistently beaten the S&P as well. So anyway, it just so happens. You can see from those numbers a couple of things I want to draw out. First of all, there's no guarantee that they would only ever go up. There've been negative years, I think, in every single, negative to zero years in every single one of those various portfolios. Some of them aren't older than, say, 2021, for the simple reason that some of the products didn't exist then, so you couldn't have it. But the point is, look at the variance of returns as well. This is the other thing about not panicking and not getting bored. There will be variance, not just from the volatility of what's happening in the Middle East, but 2022 people forget that's when interest rate was starting to rise. So forget 2020 with COVID, didn't make much of a difference, or 2018, which at the back end was a bad year. As again, the reason for blank spaces is because if the securities didn't exist then, we can't have a portfolio of non-existent securities. Okay. So again, broader points, but we're going to get into specifics. This is the past week. So the biggest news item obviously being the Middle East. What's been the impact? Well, actually, yes, it looks a lot more red than the past year, but it doesn't mean this is how it's going to finish the year, of course. And you can see that obviously it's not all green by any means, but in another week that could easily turn all green. The volatility is far greater in the short term than the long term, is my point. In the longer term, volatility tends to be a lot less. Okay, these movements settle down. Week to week, you'll get a lot more reds and be in the wrong block. So what is doing well? And this is, again, another mistake I want you to avoid as retail clients. Don't try and jump from, oh, you know what, I've got to get out of some of the reds and into the greens. And I'll do that every week. That's trading, and you better have a hypothesis you've tested for trading. Otherwise, you're going to have one hell of an accident and quite a mess up. Okay. Hi, David from Cape Town, Peter from Surrey. We've got Teddington in the house, central London as well, and the Situation Room, Colchester, and everything else. I'll answer questions at the end, if you don't mind, if that's okay. Not that there's any up at the moment, but I will answer questions at the end on this. So thank you all for joining at such short notice. My point is, okay, right. So we know there's money out there. You can see the greens. Really, the biggest problem retail clients face, as I've already mentioned, is that panic, that boredom, that moving around, is actually not finding good quality companies and leaving it alone. And so I'll go into some of what we earn and why. And by good quality companies, it's why we have to go through 10,000 of these. You won't believe it. We had one client who said, oh, my employer doesn't let me hold stocks, and there's only about 10 ETFs I can hold. Can you still get me something which will beat the S&P 500 every year? I thought he was going to say every day for the sake of it. Absolutely insane. That's why we have to go through 10,000 securities, because we need to narrow it down. None of these fit our box. Sometimes clients see this and go, oh my God, you're showing the holy grail. I'm not, because none of these meet all our criteria. Everything has to be green. And you can see why, because we need to allow for resilience in an uncertain world. Whether it was tariffs or the Middle East or whatever Captain Chaos is going to create, we have to have resilient companies who we can entrust. We're trying to navigate all of this, and they might not all of them do it. Therefore, we need more than just one company in a portfolio. So it's 20 to 40 companies, 2.5% to 4% in each. These simple building block principles are established not because I woke up one morning and thought about it, but because out of logic and out of the academic research. And the academic research shows undervalued companies which are growing tend to be more resilient. In other words, tend to rise more often and have shallow drops than ones which are overvalued and are not growing. And you might think that's bloody obvious. Yeah, well, the academics put numbers to it. Companies which generate cash for the amount of capital they invest. So let's say I buy an iPhone, that's the capital investment, but I can do, I don't know, I make OnlyFans videos and I get lots of cash coming out of it. Those companies tend to perform better. I know you'd all love to see that. Tend to perform better than those with lots of capital expenditure. You've got to buy lots of iPhones and get no cash coming through the door. You might as well, that's bloody obvious, Alpesh. Yes, and Goldman Sachs put that together. Sometimes the very obvious and basic that we don't do, which is why everybody isn't rich, for the simple reason they panic, they get bored, they try and do momentum. Oh, in this past week it did this. And they have recency bias. Oh, it's all about the Middle East, all about the Middle East. Oh, God, we better panic. We better just make investments which fit into cybersecurity. Well, think about it. Out of 20 securities, my job is to make everybody rational and calm. Rational and calm. You can write that down. Rational and calm. In the sense that, okay, let's say you like cybersecurity. Now, unless you're a crazy billionaire hedge fund manager, you're probably not going to put all your money in just cybersecurity. And by the way, if you were going to, I would say those themes are pretty bloody good. But you're not going to, because it'd be a bit stupid and it'd be difficult to explain to your spouse why you've gambled your entire future on just one theme. So then it comes to, well, okay, I need cybersecurity. Fine, fair enough. let's say you don't do any of the research about value, growth, income, or anything else, how much are you going to have? Maybe 1 or 2 or 3 companies in cybersecurity? Well, that's 5% max in each if you have only 20 stocks in a portfolio. If you have 40, then it's 2.5, 2.5, 2.5. So you've naturally got that diversification and lack of over-concentration. Now, if you said to me, no, I really want to concentrate, then okay, fine. Then you're willing to take a risk. So presumably you're willing to me just throw a dart at the dartboard and say to you, okay, go for artificial intelligence enterprise companies in that theme and nothing else. And you'd soon wake up saying, oh my God, I've got buyer's remorse. I'm scared senseless as soon as you did it. So be warned of recency bias and what you see in the headlines. And we will actually, I'm going to take you through the headlines in a second and what all of this means, what's going on, bang up to date as well. Okay, so we'll look at all of this and which ones are moving up, which ones are falling, and why. Now, we're going to simplify our decision making by allowing for the fact that we're not going to be trading. That's completely different. We're not here to trade. Hi, Anil. Good to see you yesterday. We did an event in Parliament yesterday, so I got a few people and then dinner afterwards. Okay, so what else is the past week? Well, here's the world. Now, again, I want to remove some of the things you've been taught, which are just wrong or lies, which is, oh, don't worry, you should invest globally so you can diversify. Middle East crisis, presumably that's when you need diversification the most. Where is it? Oh, I know, Alpesh. It comes from Shopify. Yeah. Okay, or Petrobras. Where's your diversification? Everything's falling in the same direction. British companies, Irish companies, Chinese, Japanese, Taiwanese, Indianese. What the hell? So IFAs don't understand this. Okay, because an IFA or St. James's Place will say, because they want to sell you a load of products, they'll say to you, oh, just invest globally because you'll be diversified. And if you were ever to point out to them, well, wait a minute, Warren Buffett became the world's richest man by only investing in one geography. Oh, yeah, don't forget about it now. He's beyond it. He's past. No, they're too volatile. America too. I'm not saying you should only be an American, but what I'm saying is you've been fed a lie that you necessarily need to complicate your life through global diversification to give you some kind of cushion against falls, because it clearly doesn't. That's the past week. And I purposely wanted to do this webinar during a week where there was extreme volatility on a single specific issue, like what's going on in the Middle East, so I could make this point to you at the right time. And I wrote about this in one of my Financial Times columns, which some of which are in this book. I will give you a free download during this webinar of the book, but in case you miss it, it's alpeshpatel.com, and you'll be able to download a free copy of the book. And I've got wonderful reviews on the back jacket from Financial Times, Peter Temple, from Philip Hampshire, Bloomberg, Bernard Opperty, who is a multi-billion-dollar hedge fund manager. So it's free. So do read the book, and it's published by Palgrave Macmillan, famous publishers. Now, the point is that I wrote in one of the FT columns, and I've written that, and I very much focus on data, is when markets fall, correlation to the downside increases. The posh way of saying everything falls together. So again, your IFA who has a conflict of interest with you and wants to sell you stuff won't know that, won't understand it. For us, when the markets are falling, yes, there's this correlation number you can see there, but that number is dynamic. It changes and it increases and tends to one means lockstep. When markets fall, when you need diversification the most. So we don't overly worry about it. By the way, all of these are listed on the New York Stock Exchange. They can all be in your SIP or ISA. So you don't need to have Chinese yuan or Japanese yen or Indian rupee accounts in order to buy stocks representing those countries. They can be in your SIP, ISA, 401k if you're from Australia, New Zealand, Canada, or wherever. So again, you were sold this idea that, oh, it's awfully complicated. You better give it to a fund manager because only they can access these companies. They have a secret password. No, they don't. 10,000 companies, 6,000 exchange traded funds, all open to our SIPs and ISAs. Okay. But this is the past week in terms of exchange traded funds. Again, where's your diversification? Oh, Alpesh, Bitcoin. Seriously? You're going to jump into Bitcoin when the world is volatile? You really must like risk and volatility. So again, if you've got Bitcoin, and I happen to have Bitcoin, I've got Ripple, I've got Ethereum, how much of my total assets well, in my case, less than 5%, I think. I haven't worked it out because it's not part of my stock portfolio anyway. But if I thought all of my assets, I'd probably say well below 5%, actually. I'd probably say closer to under 1%. Did it for a bit of fun, just as if I go to Vegas next week, I'll have less than 1%. Now, it's not to say people haven't got rich off Bitcoin. It's not my game, so I don't play it. Baccarat's not my game, so I don't play it. I leave it to James Bond. So similarly with this, I don't want you to trade, jump in and out. Namos, why don't you teach us to trade? Why don't you teach us to trade? Well, that's more complicated. It's a separate webinar for wanting to do trading, and most people can't do it. It requires a lot of concentration and being in front of the screen a lot more often. Investing's a lot easier. The temptation with investing, which is buying and holding, is, you know what, I'm missing out. Something somewhere's going up. Not this week, though. And people are thinking, oh, actually, I'll take it easy. Because what have you got? Well, okay, you've got crude oil USO has gone up. Did you see that coming? You might say, well, in hindsight, of course, it was obvious what Trump was going to do. In hindsight, the man was serious. Whenever he said he's going to do something, he's going to do it. But Trump all the chickens out. None of it was obvious. It's absolute nonsense. And by the way, developed markets and emerging markets are the exact opposite. How come both their exchange-traded funds, so a broad breadth, have both fallen? Where's your Alpesh, you should diversify your developed market holdings with some emerging markets. Are you kidding? Guess who's going to get hit the most? So the point is not that you shouldn't, just because you got developed, you shouldn't have something else. It's to say you're going to have between 2.5% to 5% in 20 to 40 securities. And depending on your age, the older you are, the more you'll hold in cash. If you've got 1 year to retirement and you need your entire pension fund, you can have 100% in cash, because you don't want your pension to lose 20% the year before you need it all in cash. Okay, to work out those exact numbers, how much do I need? How far will it go? We created free apps and tools, completely free, on campaignforamillion.com/tools, because I got fed up of seeing these adverts where these IFAs and wealth managers want to charge you a fortune to give you that information. We said, well, wait a minute. We're in the age of AI. We can create all these apps, put them together for people, make them absolutely available for free. We'll take on the cost. So you can see that. campaignforamillion.com/tools, totally free. How far will money go? What if you grow more? What if it grows less? What if you have a string of bad years and you need to withdraw cash compared to a string of good years in the market? Then what would happen? What if the growth rate was 5%, 15%, 30%? What if you needed more money, less money? What if you could? All of those things you can play around with. Because if you think about it, there's a lot of questions you'd have and a lot of what if. Well, that needs an app, a clear, simple one. So we made it free. Yeah, I know, I'm saying it again. And I mean free for life. I don't mean free for a week and then, you got to pay. And we've had a lot of people saying, why the hell aren't you charging for this? And I said, well, no, because I want to make the point. We want to do some good stuff out there, which helps people. So I'm not chasing any of these ETFs. Okay, what's the past week for the NASDAQ 100? This is the NASDAQ 100. Does that mean we dive and trade into Microsoft, NVIDIA, Broadcom? Well, it is if you want to try and be a trader. But if you're not trading, you're having to leave things alone. But Alpesh, what if you see the market falling, which we do, and I'll show you that in a second. You're saying you just sit there and take it? Well, I'll come to that point in a second as we... Well, actually, no, I might come to it now. So what do we see happening with the S&P 500? So we did a dinner yesterday for some of our clients. And I showed them this. Okay. And well, I got a print out of this. Now, where are we on this? I just want to show you. Whoops, not progressive, SPX. Okay. You can create this for yourself on Yahoo Finance, on TrendSpider, TradingView. There's all sorts of things. Sorry. I'm trying to get rid of stuff when you've got bloody stupid adverts popping up all the time. Let's see if I can get it up a bit later. And I hate some of these tools because they're so rubbish at times. They let the IT engineers loose on them, and that's when you know you're screwed. Once an IT engineer is loose on something, it'll never work properly again. So this is where we are on the S&P 500, and I'm going to show you in a second exactly what that means, in terms of where we are. Okay, I'll put that up screen in a second. Okay, so this is where we are, as you can see. and it's falling. It's what we might call a mama bear. What's that? I'll show you in a second. Okay, it's falling. As it was here, and as it was here. So as I've said many times before, there's only one of three things can happen, and there's only three choices you have. There's three things that can happen. Is it could just bounce up and go up and up and up. It could, of course, have a fall like this. That's the second thing, and a quick V-shaped recovery. Or it could have a prolonged, deeper fall, a U-shaped recovery. That's the third thing. You've only got three choices. Do I buy, hold, or sell? Well, I wouldn't tend to buy when this is falling. So that removes that one. Do you hold or do you sell? Well, if you hold, the danger is you have a U-shaped recovery and you're holding and losing money for a very long period of time and you can't buy back cheaper. If you sell, the problem is you have a V-shaped recovery and you might sell near the bottom as you sell too late and you end up buying back more expensive. Got it? Hold or sell depends whether it becomes a U or a V. I don't know whether it's going to be a U or a V, but what I do know is statistically tends not to be a U as frequently as it is a V. So on that basis, you might say, well, actually, Alpesh, I'll take the risk and I will assume it's going to be a V and therefore I'll just hold, appreciating that it might fall 20 odd % and I might have a bit of a sickness to that. Okay? Very simply put. Now, so you end up holding. It's very logical, very clear. We put it in these terms for each one of those. And if you're wondering, a mama bear is, for those who don't know, it's when the moving average is starting to fall. Daddy bear is where they cross over. Okay? So I'll just put this up. If you've not seen it already, feel free to take a picture. And for most people, this ends up the best thing to do. And the way to work it out is simply this. What hurts you more? Now, like I said, for most people, they should just be doing this. Now, I'll tell you the classic mistake they make. And by the way, if you want to see this historically, we're at 0.3 now. 0.3 is falling MACD, baby turn to mama bear, risk averse are out, risk neutral, exit all or more if it falls further, risk loving, just hold. Okay, so let me explain that more clearly again. A daddy bear is where the green falls below the blue. Hey, man, so what about the narrative? What about Trump? Well, we can't see into Trump's future, but what we can see are prices and momentum. And I tend to find this works better than trying to read news headlines. It's not guaranteed always to give you some kind of crystal ball, but looking at prices and where people are putting their money, or more importantly, at the moment where they're not putting their money, gives you a pretty good idea. It doesn't work with all securities, but helps with an index like an S&P, for instance. Okay, and where are we at? We're there. Well, wait a minute, Alpesh, doesn't that mean I should trade in and out? Well, the danger with you trying to trade this is at first you'll say, I don't want to get out, 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 I'm scared, I want to get out now. And then the price rebounds. Oh, I forgot to buy. I'm too scared to buy. I'm too scared to buy. I'm too scared. So you get out at the bottom and you get back in at the top. Common pilot error of retail clients. So I say to retail clients, I can show you the theory of how you're supposed to fly the plane, but it doesn't mean you'll do it properly. You'll have pilot error. So in most cases, people would and should just sit through it. If they don't want to, they could exit a little bit now because they might say, I'm a bit panicked. There could be a V-shape. Do you know what? I'm going to sell 10% of everything or 20% of everything or 30 or 40 or 50. But you better remember to get back in when this flattens out, which is why doing nothing usually is the better thing because you're avoiding causing yourself pilot error. When it's quite serious like this one, and we're not there yet, the time you exit, you'd still draw. You've never got the top or the bottom exactly. You've still lost quite a bit before you exit. And you're hoping then it'll drop even more and you can buy back cheaper later. Now, is that going to happen? Is it going to be U or V? We do not know. We don't know. What I do know is I fully expect a 14% drop. As I've said since the start of the year, I expect a 14% drop at some point. Why? Because statistically, I'm just playing the odds. I expect some kind of fall to 5,800. So another 1,000 points on the S&P at some point. Now, if you look at the individual stocks that make this up, you could apply to Meta, Microsoft, Apple, Amazon, Alphabet the exact same principles. And if you sit through it, in the case of this, then yeah, I'm afraid you're sitting through a 28% drop. But why would you do that, Alpesh? Well, okay, don't do that then. Try and trade it through. And if you want to try and trade it through, then you'd start exiting when the green is dropping, and then be all out once it's crossed the blue, and then remember to get back in. That's perfectly fine. You will have pilot error. Because what you will do is you won't do it. You won't execute it. You know why they pay hedge fund managers so much money? It's not because we can work this out. It's for our discipline. We'll do it. I did a Radio 4 interview 25 years ago with a poker player. And the interview was how poker players and traders who are slightly psychotic, and by psychotic, I mean it in the technical psychiatric term, have a lack of emotional empathy, tend to do rather well at both poker and trading. And we looked at the academic research, and I explained the research to people. In other words, they have the discipline to cut. Sociopaths are people who do that to other humans and kill people without any emotion. Traders are the ones, and there's research on this, who will do it to a loss and get the hell out. They won't sit there, I hope this turns around. I hope that Trump does something good and my portfolio won't keep falling. No, we get the hell out there. If we're trading, I'm not trading. This is an investment portfolio. I'm not trading this. But if I was trading, bang, that happens, we're out. No emotion, psychotic. Okay. And that's why most private investors will fail at trying to trade their investments, and therefore they should just leave it alone. When people say, it's not timing the market, it's time in the market, they don't know why they're saying it. The reason they're actually saying it is not because you can't time it. Hedge funds like Winton Capital are multi-billion-dollar businesses because they can get out. Hey, look, there's a simple algorithm. Get out there. Basically, get out when the green's falling, get in when it's rising. Hedge funds can do that. Private investors have pilot error. They just won't do it. They'll go on holiday. We've got one client, keeps on bloody going on holiday. And then before he goes on holiday, and he'll do this on leverage, he'll say, I just, from the airport, I just want to check in. Everything looking all right? Insane question to ask. Goes off on holiday, does 2 times leverage on this. It drops 10%. He's down 20, let's say. And he'll go, what happened? I said, well, mate, you were sitting on a bloody beach is what happened. Pilot error. So don't try and certainly do leverage, but don't do the timing elements. I'm telling you, but I'm explaining it to you because I think knowledge is important, because your first instinct is, why don't I trade this? Why don't I get out? Okay. And you could, when the green's falling, make sure you're out. When the green is rising, get back in. Simple. There's your algorithm. All right. There's your algorithm. You don't even, Alpesh, did you say that? Yeah, I'm telling you now, and you can take this forwards and you can take it backwards. It's in the books. When the green's falling, get out. When the green's rising, be in. And yeah, there'll be periods when you're confused and you're going in and out, in and out, in and out. Right? So, but you won't do it, and you shouldn't do it because it's trading. You should hold it and do what Warren Buffett says, which is bloody well hold it and keep hold of it and stop faffing around. Trying to be a fund manager. So where are we at the moment? Well, we're not getting into Microsoft, even though it's up 5%, because we've already got a holding. Buy, hold, or sell. Would I buy more? No, because I've got enough of a coverage. I've got 5% in it, so I'm fine. Plus, in any event, the MACD is falling, the moving averages are falling. Would I continue holding what I've got? Yeah, because I didn't decide to get out on the mummy bear or daddy bear, so I'd continue holding what I've got. Would I buy more? No, because I'm happy with the holding that I've got. So would I sell? Well, no, because selling would have been when it was at the mummy or the daddy bear stage. Okay? Simple. In the end, you're not having to move around. Well, wait a minute. What if we haven't got Meta, Microsoft, Apple, Amazon, Alphabet, JP Morgan, Goldman Sachs, Micron, AMD? Then what do we do? What should we have? Well, we'll look at some of the things of what people might have. That's where we are. When we combine it together, what we're hoping for is our Microsoft and our JP Morgan investments both get combined, but are not moving in tandem. This is what diversification is. It's that lack of correlation, diversification. So in the end, by combining 2 investments, we eliminate risk. The mistake private clients make is to think, oh, something, investment B is falling, I'll get it, it looks risky, I'll get rid of it. And they're left with just investment A. So they've actually increased their risk by removing a risky asset. Harry Markowitz, Nobel Prize in Economics for that. So don't feel bad if you think, geez, this is genius. If there's an image, there's a whole load of images I think people should just print out. That's one of them. They should put it on their wall. Okay, the other one is this. Should print it out, put it on their wall. The other one is this. Okay, just flipping amazing. It's like, wow, Alpesh, you're right. This is art. This is better than the Mona Lisa. There's little things they remember as to what they're doing, why they're doing it. Like I said, why do we have our holdings? Because undervalued companies tend to do better, and they're not green. If they're not green, they don't qualify. Undervalued companies tend to do better than overvalued ones. Growing companies tend to do better than ones which aren't growing. High sortino, i.e. high average return, low downside volatility, tend to do better. But there'll be people listening to this going, so I only need one of these. No, all of the things. And even then, you're not guaranteed things are going to go up because Trump might throw a firework in an oil field. But that's why you hold for a longer period of time, to allow things to settle down. So all the mistakes that retail clients make, now's a perfect time with what's going on to explain to you the mistakes you might make because of what's going on, and so that you avoid it for the future. Now, we took Goldman Sachs research, but we took the research in terms of what's happening, and then these are our slides. So just so you know, they're not Goldman Sachs slides. We've taken their research, but put it into our slides because they didn't actually have slides. They just had a load of text. So we've simplified things. And they're talking about there'll be a slight impact on global growth, on inflation, as you'd expect. Oil, worst case, could spike. It's a tail risk. They call it $100 a barrel, 150 are the numbers we're hearing. Don't let any of this panic you. In a way, what they're actually saying to you is the impact most likely is minimal on global GDP and on inflation. And yes, there is a small probability, and we don't know, is what they're saying, of a big shock. But even if that happens, what are you going to do? Go into cash now? Probably not, because you'll miss it, because it's an uncertain future. In a way, what Goldman Sachs is saying, we've took all our best brains, all our people who know everything, and we still end up with what we just don't know what's going to happen. Okay? Now, I'm not going to try and gamble and go to Ladbrokes on what's going to happen, whether this is going to happen or not. Now, there are people, you read about in the press, maybe hedge fund managers, maybe gamblers, who will say, I'm going to do a Ladbrokes bet on this. I think oil's going to go to $100 or $150. It's very simple to do that bet. You can either do it in the futures market, the options market, or in Ladbrokes. There's many ways to do that. I don't recommend it. Unless you want to gamble, and I'm not here to gamble, we're here to have a pension. So I'm giving you the background, and the background for us has remained the same, which is, unless you're going to trade, as long as you've got a good quality portfolio, then this is going to be probably the best thing for most students to do. It's not to say the markets won't fall, it's that they're not good at catching falling knives. And therefore, logically, you need a quality portfolio with some degree of resilience, 2.5% to 5% in those 20 to 40 stocks. They won't all rise. We don't know which ones will. That's why we don't have just one stock. Otherwise, we'd do one. And if you wanted to just have one, hey, pick something in artificial intelligence, but you better not hold it for a day. That'd be like me saying, put it all on black at a casino. This is the Goldman Sachs global rule of thumb. A 10% increase in oil prices means global GDP drops by 0.1%. Headline inflation increases 0.2%. In the bigger scheme of things, negligible. Negligible, okay? All exporters gain real income while emerging markets absorb the heaviest growth lag. So, in other words, guess who's going to suffer the most? Well, UK. It's like we're made for it. India possibly looks like they can buy Russian oil again because the Americans have allowed them. I mean, given that US foreign policy is pretty much dictating how India grows and where it gets its energy security from on the basis of what the US president's saying, it doesn't seem that big a deal that they say, well, we're going to appoint leaders in Venezuela and Iran. morally, you might think, well, that's bloody awful. But it's happening. So those are the links. The loser, steep drags on real income and spending under $100 per barrel scenario, global GDP drops. Okay. Winners, net positive GDP impact driven by structural positions as oil exporters. Who are the oil exporters? Latin America, Venezuela, Americans, Canada. I don't think the Americans will suffer that much. But there we go. We're not gambling on it. But what I'm saying is, hey, for all those people who are told, hey, you should diversify into emerging markets. Well, no, it's fine to have emerging markets as long as if you're looking at exchange traded funds, then what I would suggest to you is, again, you're going to have maybe, because they're already diversified, 5 to 10 exchange traded funds because of the diversification. And I want to show you something. There's a hell of a lot out there. Okay, so if you are going to pick whatever you're going to pick, I'd really go with the high Sortino ones with good, consistent track records of delivering great returns. And I'd probably want 5 to 10 of them. That's it, because they're already inherently diversified. You've got everything. You've got Corp, Japan, USA. It's the Sortino and the rising MACD, which I'd say are the two most important factors in my experience, which lead to returns in exchange traded funds. High Sortinos, rising MACD, which I've just already shown you. The high, momentum is one of the most important factors in those. Inflation pressures, emerging markets are going to get hit. But guess what? This war could be over in a week. We don't know. And anybody who tells you otherwise is lying. So Goldman Sachs send this kind of material to their clients to say, here's what we're thinking, aren't we clever? And then they'll try and get the clients to move things so that they earn some commissions and look useful and earn their keep. I don't have that conflict of interest. So I can just tell you, well, the best thing is continue holding the portfolio you've got, because this thing could be over in a day, a week. And if some of our holdings take a hit for reasons and sort of the maze of ways in which things work, then others should benefit because they're all good companies which are undervalued, high growth, dividend yielding, and profitable. But yet you could easily have a portfolio of 20 companies where 5 have a negative year, the other 15 are up, and it's fine. You're still doing well. The more there's a global tailwind, the easier and better it is for you. But are we going to get a collapse of the global economy this year? We don't know, but I put a low probability onto it. Okay. So yeah, there's a bit of a shock to global growth, but it looks like, I don't think it's that big, but there's a small probability, and it all comes down to this, probabilities. There's a small probability of an extreme calamity. That's like buying insurance. What's the insurance? Well, keep listening to me, I guess, is one thing, because we're going to collect information not just from Goldman Sachs, but from all the brokers and everybody else. So all of these things you're reading, to put it into a context and focus on your portfolio, is yes, there'll be some upheavals, as you can already see, but there doesn't seem to be a strong enough reason for a private investor to completely go into cash, unless they do want to do the mummy, daddy, bear exercise, albeit that they must allow for the fact of pilot error and they'll execute it incorrectly. We're in a mama bear at the moment. If you want to do mama bear, you go completely into cash on everything until the S&P is flattened out. But you might end up in a V-shaped recovery buying back more expensive, but that's the price of insurance you pay. And as I say, for most people, they say, nah, I'll just leave it and sit it through. On the basis it won't be U-shaped, it'll probably be V-shaped. Okay? Psychological effect of de-anchoring inflation expectations. Essentially, inflation could stop people buying or increase savings, and that could have a longer-term impact on consumer behavior. But guess what? Unless interest rates start rising, the market isn't going to have a U-shaped 2022 fall. Okay, unless they start raising interest rates. Oil price shock. Surely 1973, this is going to be a problem. Okay. Guess what? Thankfully, central banks typically do nothing in response to oil price shocks, right? So the good news is they're not going to raise interest rates to temper inflation. Now, that's the key thing. If there's something I want you to take away, is that if they don't raise interest rates, the stock market keeps growing. Why? Well, because interest rates are the thing that the market is really concerned about the most in the US. Now, what about the UK? Well, UK is gold mining stocks, and gold hasn't spiked up on this occasion. And it's miners, metals, and banks. So that is a diversifier. But how much are you going to have in a UK tracker? 5%. 20 to 40 securities, so that can only be 5%. Okay? So don't worry about this, it's a bit more technical, but we're not expecting interest rates to rise. That's fine. Goldman Sachs are actually expecting a delay in interest rate falls. Fantastic. That's good for the markets longer term. So we see through the fog of war, we say, actually, we should be pretty all right. Yes, there is a small risk of what the Qataris are afraid of, $150 on oil. They're not actually afraid of that, by the way. They're the ones who are talking about it, I think, today. It's just a message to Donald Trump in a polite way. This could go pear-shaped. So overall, the most likely scenario is we'll do fine. We're going to get these wobbles. If it wasn't this, it would have been something else. So like I said, I put together Goldman Sachs slides and then JP Morgan and Morgan Stanley. This is JP Morgan and Morgan Stanley stuff. Core assessment, 65%, the regime collapses. That's got nothing to do with our stock market. The real problem with our stock market is if oil continues higher, well, even that's not a problem because it's interest rates we're worried about, and they're not going to change interest rates, even if oil prices spike. So in a way, once again, we're fine. Now, if you said to me, I want an oil trade, that's a trading thing. We can do that later on. Okay, Harpreet, everyone else, I'll do the answer. I'll do the questions in a second. Just want to get through some of this. So it is amazing what they're doing, as in it's an outlier. We didn't expect it. And now the discussion is all who's going to run out of stockpiles first. Well, that's a distraction to what's going to happen with the market. And I can tell you, the companies that I have invested in, okay, the various companies that I've invested in, let's say JP Morgan, Goldman Sachs, whatever, NVIDIA, Meta, Microsoft, Apple, Amazon, Alphabet, Lam Research, a whole bunch of others, I think they can handle all of this. I fully expect them to, so I'm fine with it. Now, I don't expect them all to only go up, and I don't expect them all to beat the S&P every day or every week or every month or even every year necessarily. I think as long as my portfolio is going to be growing, and I wish this war hadn't come about and the markets only ever go up, but wishing doesn't make it so. Okay, so all of this you're going to see. Don't get distracted from what's the issue about the stock market. Are interest rates likely to go up? No, they're not likely to go up. They're not likely to go up, but there'll be a lot of scary headlines, which I'll come to in a second. Oh, wait a minute. Well, Alpesh, does that mean I should invest in banks or I shouldn't, in maritime, supply chain, aviation, infrastructure? No, if you've already got a bunch of stocks, I don't care what those companies do. And I'll tell you why. If you were to go ahead, let me just show you what we do with clients. Okay. If you were to go ahead and go through all 10,000 securities, the things which correlate to stock price movements are value, growth, income, cash return on capital invested, momentum, Sortino. Do you know what doesn't correlate to movements over the long term? The sector they're in. It might in the short term, but longer term it doesn't. So that's trading. Sectors are trading. You know what also doesn't correlate? Correlation. Market cap does in some periods. Small caps sometimes win, bigger caps do, but actually what correlates the most is value, growth, income, cash flow, Sortino. And people get confused. They think, oh, I must gamble on sectors. If you want to try and gamble on the sectors right now about what's going on in the mind of the future Ayatollah, good luck. Let's put it this way. There is a Security Council within Iran at the moment thinking of what to do next. Now, there's no way. What do you want to do? Do you want to gamble on what they're going to do next with aviation and infrastructure stocks? Well, that then you have made investing into gambling and speculating. And what we're trying to do is make investing into investing, which is value, growth, income, cash flow, Sortino, and I've got to sit back and the world will keep throwing things. I'm not trying to guess. Now, if we were doing a trading webinar, then sure, where we're holding things for a day, a week, then I might say, look, guys, hold this. If it goes to this level, exit. If you get a stop loss at this, get the hell out of there and move on. It's not what we're doing. We're investing. It's very important to know what's important to us, keep focused on what's important, and what our responses are. Long-term bull case, this came out of JP Morgan, okay? And there's a whole bunch of other stuff as well over there. I'm not going to go into all of these because there's quite a lot of stuff in there to show you. AI sovereignty and the new global power structure. What happened to AI? We forgot about AI. Yeah. So the worry at the moment is somebody asked me yesterday at the dinner. That's why I want to show these slides on AI. They said, do you think the US will keep its control over AI? Well, they've said they're going to, and they want to, and they don't intend to make it easy for anybody else. So the thing about sovereign AI is you can create your own artificial intelligence in your country, but it's pretty difficult and expensive if you haven't got access to US AI technology. So the Chinese are trying to create their own. And the Americans at the India AI Impact Summit talked in terms of just making sure they've got self-sufficiency and strategic autonomy. Okay, and they want to be the world leader, and they know that's the name of the game. So I've no problems having a whole bunch of US securities and stocks, because the Americans aggressively have made clear they want to dominate in this space, and they will destroy any competition and not make it easy for them at all. There's a defense dialogue going on in India at the moment, and the assistant deputy secretary of state from America said, we're not going to make the mistake with India, and this is to an Indian audience, that we made with China. We're not going to say, hey, let's bring you into the world so that you can be successful, and then we get outcompeted. And he said it openly. And I said it we had a women in business event yesterday. I said to the women in the audience, if you think men are going to just sit back and say, oh, great, let's bring in more competition. I tell you what, here's the food off my table. Let me just help you. They're not going to be like that. It's competition. So I'd rather go with the one who keeps winning, the Americans. I don't have a problem with the geographic issue that so many other people do, which is, I'll just get rid of a whole geography. Well, you can if you wish, but I showed you the world map a moment ago, and you saw how everything was falling anyway. Okay. Pure technology's verdict, why proprietary wins. So JP Morgan think the Americans win because they've got the intellectual property. Now, the idea is the Chinese can invent, they can steal, they can spy, they can produce something. So be it. The Americans are going to stop them using it, except in China anyway. I mean, I tell you this, if you're living in the West, which is where the profits are, then it's not to say there aren't profits in China, but there's a hell of a lot of profits out of the EU and the US. And you think you're going to come along, the company's going to come along and say, well, we use Chinese chips. Well, they'll do what they did with Hawaii. If you remember Hawaii, who were doing 5G networks, they were just banned in the UK. I was on the BBC doing a newspaper review at the time when it happened. And the security services said, nope, we don't want their chips. What do you think they're going to do? And that's just bloody 5G. What do you think they're going to do with AI? No, the Chinese aren't going to be allowed in. And if you want to know how bad it is, well, somebody was telling me how most of New Delhi's cameras, traffic cameras, are hacked and infiltrated by the Chinese. Well, if the way they got the Ayatollah apparently is because the Americans could hack into the cameras in downtown Tehran. So they knew where he was. Once they knew he was underground and safely in his underground bunker, that was it. Game over. Okay, so yeah, it's going to be the Americans, and they're not going to go down without screaming fight. They're not going to go down at all. As Warren Buffett put it, don't bet against the Americans. But I don't care about the geography. I care about the companies. I don't care whether they're American or Chinese or whatever else. As long as I've got value, growth, income, cash flow, Sortino, my morality doesn't impact my investment decisions at all. Investing is investing. Morality is morality. Two different things. I'll absolve my sins through reincarnation or the church on Sunday or something. Or governance in the US dollar metaphor. The dollar, dominance or not. Again, this is something which comes up a lot. But if I buy dollar assets, what's going to happen? Well, at the moment, it's actually relatively cheap. So to convert my sterling into dollars is actually good. Do I think it'll get stronger in the future? I think it's an asset that I hold like gold, and it'll go up and down. I don't care. I'm holding it for the long term. I'm only 54, so I'm going to hold it until I'm 45, 145. So I'm not bothered about the movements. If you are bothered about the movements, you shouldn't hold a foreign currency. If you're bothered about movements in stocks, you shouldn't own stocks either. Okay, but we've forgotten about AI and what it's doing, and not just the banks, not just the AI companies, but the people using it know it is bloody good. What's going on? Why are we doing this? Because this is what we're trying to do. These are the contributions in our SIPs and ISAs, and my son's, he just turned 8 a week ago. And so he's up to about here. Is he exactly there? No, because guess what? There was COVID, there was 2022. So his ISA went up and down like this. And the markets were rather good over 2023, 2024, and 2025. He got lucky. 2018, the year he was born, they were pretty rubbish. 2020, despite what happened, they were okay. 2022, they were awful. So he's slightly above this. Why is he slightly above this? Well, because 2023, 4, and 5 were exceptional years in the markets. And so he was able to do exceptionally well in those 3 years. But then again, he's 8, so we could afford to have a concentrated portfolio for him. The idea is that if we can get an improvement, maybe it's 5%, maybe it's 10%, maybe it's 15%, whatever that is, over, and we'll only know in a couple more years, then that's his additional gains over a period of time based on how much capital was saved. Now, an ISA only allows you to save about 12,000. But if you've got whatever extra money you've got saved, this is a 250 portfolio. So somebody in their 40s, 50s, maybe 250, usually 40s is about $250,000. Then the idea is if you get a slight improvement, then over the next 10 years, that's what you're trying. Now, if we keep getting 2023, 2024, 2025 stuff, then you're more likely to be here. If we keep getting bloody war all the time, you're closer to here. And if the markets never go up again like 2022, you're never going to make a gain again. I'll say that again. If the markets never go up ever again because of, I don't know, whatever reason, you'll never make a gain ever again. You can't, if all companies keep falling, you can't make money. Obviously, you can't invent companies that don't exist. So this is all predicated on the assumption that the markets continue doing what they've been doing over the long term, and people continue liking profits and people continue liking growth and so on. I'm going to show you some of the things that we find out of hedge funds. We do this, we go through the hedge funds and the banks, and then we give our clients some of the list to narrow down from this list. So once we filtered this list, if they've still got too many stocks, once this is all filtered into all green, and they've still got too many stocks, then what we can do is say, well, let's just look if there's any of them that have been recently upgraded, just as a tiebreaker by, say, a Goldman Sachs or a hedge fund as well. I'm going to show you something else. Over the past year, semiconductors, artificial intelligence, there's a whole bunch of companies which happen to have done incredibly well. That doesn't solve the problem. Now, people often look at this and they read articles or they go to some newsletter and they say, oh my God, AMD's up 100%. You doubled your money. What would have happened if you bought it then? Or any of these for that matter. If you come to it late or early, you've still got the same problem. Should I buy it? Should I buy it? And that problem is solved by 20 securities, because you need diversification. You can't put it all in one thing. 5% to 2.5% each, so it would be 20 to 40 securities. And should you buy it is not based on a narrative. It should be based on value, growth, income, cash flow, Sortino. Does it work? Well, guess what? Yes, undervalued companies tend to perform better than overvalued ones. High growth ones tend to high cash return on capital investment. If you pick 20 companies based on a filter of all of that, will they all go up? No, never. Will they all go up triple digits? Sadly not. Because when we have done that and shown it year in year, we say, look at this. In fact, we can say, look at these over the last 6 months, and you'll see some will have gone up 100%, some gone up 0. So you say, well, why can't you find more filters until you get the one stock? And so we can't. It's not physics. Nobody has. If they had, Goldman Sachs would say to all their clients, just buy this company, you'll make, they would have told everybody, put all your money in AMD, you'll make 100%. That's all you need. Every single one of their clients would love to make 100% in a year. So how come Warren Buffett, Goldman Sachs, JP Morgan, me, didn't tell everybody 12 months ago, buy AMD and you'll just double your money? Everybody's happy with doubling their money in a year. There isn't anybody who isn't on the entire planet. So how come all these firms and we didn't do that? So we didn't know. We couldn't afford to take the risk that that'd be the one. And if we did, because that's like calling black at the casino, then surely the logical thing would be for us to roll the dice again if we got lucky. So the antidote to luck is, on speculation, is 20 to 40 securities, 2.5 to 5% in each, but they've still got to meet the value, growth, income, cash flow, so that it's not that you looked at their historic prices and thought that's a good one to buy. It's so that you reduce the risk of it being rubbish. You're not reducing the risk by saying, oh, artificial intelligence or semiconductors. You're reducing, or a narrative or a label. A narrative and a label doesn't reduce risk. What reduces risk is actually diving deeper, and that's what we do for clients. The fact that, by the way, here's another thing. The fact that I happen to own ASML, Alphabet, KLA, Lam Research, Micron, none of that is based on, oh, well, I just knew it was going to go up. If I knew that, I would have bought Micron and nothing else, obviously. Having got too much in artificial intelligence, well, there it's down to my risk appetite and volatilities. So if you look at some of our applied materials, if you look at the stock itself, you're going to panic because look at these falls and you're going to get bored. So look at the depth of fall. So depth, okay, and duration. Depth and duration measures risk. The bigger those squares, the more risk you're taking and the more likely you're going to panic. Panic comes from depth. Boredom comes from duration. They're the two things that knock you out of the market. If you only looked at this and nothing else, you're likely to panic and get bored. If you look at the portfolio of 20 securities, some of them will have gone like this so that it ironed it out and the portfolio is less likely to make you panic or get bored. That's why I say to students, please look at the portfolio level, not the individual stock, and try and inoculate them against panicking on individual stocks. So the other thing is, you could look at all of this data and say, oh my God, there's this, there's that. It's about what's important. So narratives will try and scare you. Oh, insiders are selling, blah, blah, blah. It's about what's important. How important is it? What's important is value, growth, income, cash flow, Sortino, alpha. And we know that from the research. Discount cash flow, which says this is overvalued, is actually not a good measure of valuation. For instance, we know that from the academic research. So just because you've got a lot of data doesn't mean it's all equally valid. And it doesn't mean you're trying to get it all to look good, because some things are more important than others. And some things are completely irrelevant. Most things are completely irrelevant. And if you want to know with a security the buy on dip number, it's usually, you look back at its history, this is a rough and ready measure, and you say, what's the most it's ever fallen? 35% in the recent, say, 5-6 years, and that's you buy the dip. But it can only happen with quality companies. So with quality companies, i.e. value, growth, income, you're either holding, but if you want to buy the dip without being over-concentrated in the stock, you'll do it when it's fallen by not 1% or 2%, because you'll be overexposed. You'll be buying it every week, every day, but when it's dropped a significant amount instead. Stoicism, that's what you want. That's what will stop the, to summarize everything I've just said, that'll stop the panic. It'll stop the boredom. You'll be more like Buffett, which I think we'll all agree is a pretty good thing. When we try and put portfolios together, this is 2013. We're not looking at history and saying, oh, this did well in the past, therefore it must be good in the future. No, what we're saying is, does this company currently have lots of profits? Of course, they could stop tomorrow morning. Have lots of profits on its P&L, balance sheet, and cash flow statement right now. Does it have a good price trend? Does it have good Sortino, i.e. good average returns, low downside volatility? Now, you could argue, well, that's all backward looking. Yeah, but that's, because even today's VAT return is looking at the past. But it's looking at the present, the past in the absolute present. What we're not doing is saying, oh, Monster Beverages is the best performing stock of the last 25 years. Let's buy Monster. No, that would be stupid. And it's these little mistakes that retail clients make. What we're looking at when we're looking at these portfolios of companies based on putting it all together from all of this is which suits the client based on drawdown. Not this. We halve that. We say, is that at least greater than 30%? Because if you then halve it, you're still doubling your money in 5 years. So $250,000 becomes $500,000 in 5. becomes 1 million in 10, and in 15 becomes 2 million. So $250,000 in 15 years becomes 2 million. That's the goal. If you get half of that, why half? Well, because everybody wants to be over optimistic. This is the number we want to look. Can the client at the portfolio sustain 100 grand dropping 17.5%? If they can't, then the client knows maybe this isn't for me. Maybe I need something less volatile. But less volatile might also mean less returns. And if you've got kids, then you don't have a problem with drawdowns because they've got longer to recover. But the key factor is no panic, no boredom, and quality value growth income. And then this is what it looks like for every single year. So this is Joseph's portfolio every single year. And you can see there are every single stock in that portfolio had at least 1 year where it fell. And yet that's 32%. That's what 32% looks like. Oh my God, we'd all take 32%. We'd take 15, but it just shows you that every single stock in that portfolio had a year where it fell. And some double digits, actually most double digits. The other thing we're not in the business of doing is trying to pick the biggest winners of the year. I leave that little game to journalists. We don't play that silly game. This is from Goldman Sachs Asset Management. Depending on where you are, years to retirement, this is what they say. Fixed income bank, long-term bank savings account, okay? And how much should be in equities. That's pretty useful, I think. And it's not very controversial. It's not controversial at all. Great investors figure out how people use it. There's people who are frustrated with pension growth, late starters with serious intent, independent thinker who just wants the data to do it themselves, those who want to build a legacy with their kids, usually if they've sold a business, dentists, lawyers, accountants, and the DIY investor who wants to get smarter. That's it. That's the group. And that's what we do. We take the data, put the various portfolios for the individual, and the individual manages themselves. We're not managing it. That way they've got control over it. They can sleep easy. They know why they've bought something, if they wanted to buy it, and they know why they're holding it. And these are usually the complaints most private investors have. Well, actually, you can. You can. Because you don't need more time. You just need fewer decisions. You need to know, okay, value, growth, income, cash flow, these are all green. In a model portfolio, it looks like this. Bespoke portfolio for me with that drawdown, I can live with that. Right, what do? I buy it and hold it. Okay, I don't want that one, Alpesh. Can you run the numbers again with these stocks instead and see if it still meets all the criteria? Simple. Then it's bespoke. You yourself are far better than IFAs, fund managers, and robo-advisors. So I want, ever since, I mean, not just writing these books, but ever since SIPs and ISAs were invented, even whatever they were called before, the whole point of them is that you manage your own capital. I want people to have the confidence and the knowledge to do it, but only manage your own capital if you've got the confidence and the knowledge. Don't otherwise do it, obviously, because it's your pension. But I'm fed up with St. James's Place giving 5% per annum. Okay, if you want to join the program, please do. The link I'll send you. The whole idea is what we've already said. Get an uplift, 15%, then that'd be it. No guarantees that can be achieved. Markets might never go up ever again. Our idea is we want to make sure that people manage it themselves so they get a return on their capital better than what they're doing at the moment, but at least they get control, transparency, and can pass it on to their kids so their kids know as well. There you go. I'm going to do some questions on all of this. Alpesh, do you have a number on mind when you will retire? I'm already retired. You must have multi-millions by now. Thanks for, I'm already retired. Can you show, I'm as retired as Warren Buffett and Bill Gates. Can you show the indicators you have on the S&P Yahoo charts, please? Yahoo, oh, wait a minute. I said I'd do this, didn't I? There you go. Stocks making the biggest moves today. Happy to be those. Sell-off has created a buying opportunity. How to trade while hedging risk in options, say some of them. Well, some people will buy the dips. Yahoo Finance, it's the same. Yahoo. On Yahoo Finance, it's the same old thing. MSFT. Let's go with MSFT. There we go. And we'll put up a chart. in a moment. We don't want to, you want a candlestick, you want to say year to date, advanced chart options are over here. Yahoo Finance is free, by the way. So there you go. There it is. And there's your MACD. Probably want to sign in. You can customize as well. So you can sign in, customize, and there you go. And there it is. There's the monthly. If you wanted a simple rule with something like, make sure it is monthly. There'll be a thing here in a second where you can put the settings. Oh, there you go. Interval. There it is down there. Monthly. Well, no, sorry. That's 1 month. Interval, 1 day, 1 week, 1 month. There you go. There's monthly. Zoom in. That's falling. Don't want to be in. When that's rising, I don't mind being in. It's not perfect. You are going to execute that incorrectly. You're going to panic. You're going to get bored. You will mess that up. Don't try and time it. Okay, just don't. But Alpesh, I want to time it because the markets might fall. Why should I sit on a loss? Okay, be my guest. But when you mess it up, good luck. Okay, can you show the indicators you have on the S&P? Yeah, I've just done that. Microsoft has been affected by OpenAI losing money. People shorted Microsoft to indirectly short OpenAI. Fair enough. There'll always be a reason to sell. No, it's falling. Has been affected by. How do you know? Have you spoken to every single seller? No, Alpesh, I saw a headline. Oh, you saw one headline. Have you tested that headline against all the other headlines? Was it short covering? Was it people selling? Was it revaluation due to a change in forecasts on earnings? How did you know? You didn't. You assumed it. You saw a headline and you assumed that's the reason the price fell. So when I interviewed some of the world's leading hedge fund managers, and one of which was a floor trader at the London International Financial Futures Exchange, I said, well, how do you set the prices on, I don't know, oil futures in the morning? And he goes, we look at the Sun newspaper, look at those guys, he said. We look at page 3, and then we make a decision whether it's going to be up or down. It's in my book. He literally said that. He's one of the richest people in Britain, floor trader, David Kite. How do you know it wasn't that? What we know is in the near term, that's the kind of stuff that moves stock prices. What moves it over the longer term, value, growth, income, cash flow, Sortino. He put it in print and he didn't have a problem with me repeating it. Well, given how wealthy he is, and it worked for him. He said, look at those people on the floor. Do you see a lot of Financial Times? These are Barrow boys. They all left school at 16. He goes, look at them. Do you see any Financial Times newspapers on the floor? I said, no. He goes, what do you see? I said, the Mirror, the Sun. He goes, aha. If you don't believe me, it's in the FT book, and he hasn't sued me. So you know he said it. Hi, Alpesh. Nice to see you today. Thank you. I think that's it. I missed the early part of this call. Is this recorded? It is, Guy. They're always recorded on alpeshpatel.com/latest shares. Latest/shares. Okay. Trump says no deal with Iran to end the war without unconditional surrender. We know that. All of this at the moment, we don't know what the outcome is going to be. But in the early part, I already discussed what our reaction to it should be. And we're not going to be chasing momentum. We're not going to be concentrating risk. We're going to be, it's reinforced the point. If you're an investor, you're still even more so holding for quality, but you're not chasing news items and regions, because this could equally turn like this. And all of a sudden, it's a different ball game. And we've all forgotten about the Middle East again. Okay, so there's something cognitive bias called recency bias. When I used to lecture at Oxford on behavioral finance, the cognitive biases I'd lecture on, and recency bias is, I saw it in the news, so that must be the most important thing. We all do it all the time. Okay, the people who make the most money are the ones who don't fall for all those cognitive biases, because it's the biases that often make you poor. Okay, what else? Over here, a whole bunch of these. Now, if these meet my value growth income, so be it. Somebody asked me about Palantir and Palo Alto Networks and cybersecurity. Well, I'm again, not going to go heavily concentrated into just one or two subsectors, not because I don't like a certain set of companies, but it's because I want them all to have value, growth, income, cash flow, Sortino, alpha. And if they don't all meet it, and they often don't, then they can't get in. Because all you've got to do is work out, well, how much can I possibly own anyway of anything? And once you work that out, it's really simple. Okay, I'm going to go just check if there's any other questions. I don't think there are, so I'm going to leave it at that. I'm just going to go backwards into all of this. Let me know backwards into anything. If any of it jogs any questions, then let me know. Otherwise, I'm going to leave it at that. Oh, I've got to give you a whole bunch of files to share. So let me share, including a copy of Investing Unplugged. Hopefully that comes up on your screen if you're on the webinar. If you're not, please check out campaignforamillion.com. There's a whole bunch of free tools. I'm going to show you some of the latest stuff we've just put on there, which is, I think it might even be as early as this morning. So if you go to campaignforamillion.com, you'll also see the latest webinar, why your pension is underperforming, pension calculators. These are really, really good free tools and apps, including safe withdrawal rates. Some of you might be older. You might say, well, and by the way, some of you might be younger, in which case you want the FIRE tool, which is, well, when can I get financial independence? And it will explain to you when and what the probabilities are and what you need to do, completely free. And here's the safe withdrawal rate calculator, which is, depending on my age, the volatility of my portfolio, what's the chances that I'll run out of money? And it'll give you because it's all about probabilities, it'll give you the probabilities of that as well. Okay. So you've got all of that. Where are we on the chat? Okay, good. I'm glad that was a useful refresher. And I'll leave you with, as I say, one of the more important slides. Well, this is how the S&P was a while ago. And the reason I show this is so I can't be accused of curve fitting, saying, oh no, you're just fitting it to the facts today. This is how it was previously. And I said then, I'll say it again, it always goes through 1, 2, 3, 4, 5, 6, 7. And when we did this, it was at 1, 2, 3, which is last year. Where are we now then, Alpesh? Don't make it up to suit the facts now. I'm not. This is a historic piece of evidence. Where are we now? If you look at it today, and you can do it independently of me, we're at 3. So where we are. See? 3. Now, does it mean it's going to have a sharp fall like in 2022 or a V-shaped one like this time last year? We don't know. U or V, we don't know. And for most people, they're probably better off doing nothing, not because it's going to have a V-shaped recovery, you'll be fine, but because if they try and do one of the other two, they usually mess it up. Okay, that's why. That's why. On that. So I wanted to just recap that aspect for you as well. And look at the portfolio level as a reminder, not the individual stock level, because that's the classic private investor mistake of trying to be right on everything. And then what do? They panic, because individual stocks like a private insurers might do this, but the portfolio won't drop as far as any individual stock because of mathematics. Similarly, just because something's gone up or it's in the right sector, don't fall into the trap of thinking, oh, momentum is why I'll buy, or sector name is the reason I'll buy. That's not a hypothesis you've tested. What you want to buy it for is value, growth, income, cash flow, Sortino. Is it all green on here? And then you're holding it for a long enough time for it to generate a return. Okay, so don't make that mistake of chasing narratives. Don't panic. The reason we do it, we want the improvements in everyone's portfolios to get the additional gains on a 250 or whatever the portfolio might be. That's the end goal. Why don't people do this? Because guess what? It gets exponential after about 9, 10 years. In the early years, the first 7 years, it's barely budged compared to the contributions you made. That's why nobody bothers compounding. People go, oh yeah, I get it. It's compounding. It's compounding. Well, yeah, I get it. It's a gym. Doesn't mean I've got a 6-pack. Because guess what? It takes effort and time. So people don't bother. That was all the updates, which are in the webinar. So if you're going to watch the replay, it'll all be in there. And I've gone through it. Bottom line, there's a small probability of an extremely bad outcome, but there's a bigger probability, according to Goldman Sachs, Morgan Stanley, myself, of interest rates not rising and therefore stocks being fine. Global impact on inflation is negligible and on growth is negligible. So we might get a V-shaped recovery. In other words, stocks will continue falling. At some point this year, they're going to drop 14% peak to trough. That's all fine. It's all factored in. And then they'll have a V-shaped recovery. Okay. All the other people will try and panic you to say, no, there's a very large probability of an extremely bad scenario. It's all about probabilities. There's a small probability that the world would end tomorrow from a nuclear explosion. But because the probability is small, we don't panic. If all of a sudden all you read was headlines that the probability was higher, you would panic. So would I. So it's all about probabilities and what causes us to determine what they are. The journalists and everybody else is trying to make you think the probabilities are higher than they probably are, because clickbait earns them money for journalists, commissions, brokerages earns them money, conflicts of interest. But what's the real probability? I think it's under 10% that it's a prolonged crisis. If it's a prolonged crisis, we certainly won't get interest rates falling. Rising. You'll actually, if anything, get them falling, and stocks might do well. So prolonged crisis, we win. Short crisis, we win. Either way, as long as interest rates are not going to be rising, it's all fine. Okay. Thank you all on this. Sorry, again, it was short notice, but I hope you found it useful. And do please have a look at campaignforAmillion.com, all the free tools that we've got on there, because they're really rather good. So please do have a look at those. I think you'll like them. Okay. Any other questions, you can always email me through that website as well. We've got a team now based out of, my God, London, Zurich, India, Philippines, Dubai. And so we were able to get a lot of stuff out there, including apps, videos, and everything else. And I love it just as much as I loved writing these. Okay, thank you all very much. I'm going to go back to my retirement. Thanks all.